Hello, this is Kahlil Adam, head investor at Itaú Private Bank, and I would like to thank you for joining us once again for our monthly international markets update for October 2023. This month was tough. Before turning to markets, I want to say that my thoughts are with those affected by the events in Gaza and Israel. This war, at least at the time of this video, has yet to have a significant impact on markets, but has many participants on edge for both humanitarian and market-driven reasons. Before speaking to the hard versus soft landing debate, I would clarify that from a market impact, at least for now, the biggest variable to monitor in the Middle East are oil prices. In the event of a major escalation in the war, i.e. a ground invasion followed by involvement by other nations, oil prices could rise precipitously and would challenge the outlook for inflation and rates. This would also lead to a weaker consumer globally, as oil shocks can serve as a consumer tax. That said, predicting what will happen next in Gaza is beyond the scope of this video. What I can speak to is yet another month where we remain in the same debate about hard versus soft landing. I'd emphasize by starting that third quarter GDP numbers came in stronger than expected at 4.9%. PMI numbers were stronger than expected in the US. The consumer remains very robust, as evidenced by higher than expected retail sales, and unemployment remains near cycle lows. On the other hand, inflation picked up again, with headline CPI coming in at 3.7%, same as last month, and more importantly, remains above the 2% Fed target. This prompted several Fed members and participants to expect higher rates for longer. The debate has once again shifted as to whether or not more rate hikes are needed, and currently the forecast is for a 25% chance of another rate hike through year-end. That said, conditions in Europe remain challenging, with Germany and France essentially in recession. And domestically in the US, lending surveys show that credit conditions have worsened noticeably. The Senior Loan Officer Opinion Survey, or SLOOS, is one of several measures of bank willingness to provide loans, and has reduced and, coupled with higher overnight rates, have made it so that both consumers and businesses are feeling the impact of tighter credit conditions. We have seen the NFIB Small Business Optimism Index dip after a bounce in recent months, as well as cracks in the low-end consumer, with subprime auto loan defaults reaching a 29-year high this month of 6.11%. So, there are signs that the economy is stronger and also weakening, and the tug-of-war for the hard versus soft landing debate remains. On the markets front, U.S. Treasuries reacted to the aforementioned pickup in inflation and expectations of higher rates for longer, with the 10-year bouncing to just over 5% this month, up nearly 45 basis points from the 4.572 close observed at the end of September. Equities traded inversely correlated to rates, weakening again this month, and are down roughly 2.5% at the time of this recording, month to date, and are looking for signs as to where margins will head in this Q3 earnings season, which thus far have essentially been in line with expectations. As for our committee, the spike in U.S. yields observed this month has led to a stronger dollar, with the DXY rallying to 106 from 103 at the close of last month. We took the opportunity to trim our overweight in emerging market equities to +1 from +2, while also neutralizing our U.S. dollar short position. Thank you once again for joining us this month, and please reach out to your banker or investor with any questions.